Billionaire investor buys gold and has dire warning. Before we kick off this video, I just want to say a big thank you to all of you people who have subscribed. We've just hit 15,000 subscribers, 15,003. So 4 of you is going unsubscribed. We're back under 15,000. Wow, I just thank you guys. You know, how I started this channel, I was just doing some Zoom presentations. I've been doing presentations, economic and finance and financial management presentations for years at different churches. And when the cerveza sickness started and we went into lockdown, our church asked me to run some online Zoom sessions to just give some financial guidance to people. And a lot of the young people at our church just said, "Steve, you need to start a YouTube channel." I said, I don't have the time for that. And they said, no, you know, it'll be much easier, da-da-da-da-da. And look, it was their idea. They set it up. They're the AV guys. They're the sound guys. So, you know, young Sam, young Benji, young Jeremy, all of you guys made this channel happen. And you know what? I was happy with 50 subscribers. I thought if we could get to 100 subscribers, I'd have a cool little community. And I thought I'd do maybe one video a month or maybe one video a week tops. And then it's just blown into this channel with 15,000 subscribers. And you guys message me from all around the world. I'm really blown away. And so I feel like I've got to give you guys, well, not I have to, but that you guys want good content and good education from myself. And that's what I try to give. I don't always deliver, so I apologize on that. But really, thank you guys so much for making this channel what it is. You know, I run other businesses, and I just try to slip in when I get some free time, or when I really feel like I need to share something with you guys. And yeah, I'm not a tech head, and I don't have the best technology, and you know, they're not the most polished videos, and I don't have time to write scripts and all that sort of stuff. So, yeah, that's why it's Finance Uncut. It is so uncut. It's just me talking, sharing charts, sharing information, sharing you know, different videos from around the space, and I try to promote other people's channels and other people's videos as well, because I just want to supply the best education and information to you guys. So once again, big thank you to you guys. I wish I had something to give away. I don't sell any packages or products or newsletters or anything like that. So I have nothing to give away except my gratitude and my thanks to each one of you. Thank you. So in this video, we're going to have a look at billionaire investor Stan Druckenmiller, who is one of my favorite investors. I do like the style of investing that he does. And over the weekend, I listened to an interview, and I'm going to put the full video to this interview in the description below. Guys, I highly recommend it. It is one of the best interviews I've listened to in a little while now. But in this video, I'm going to share some of the clips and some of the highlights from that interview where billionaire investor Stan Druckenmiller shares how he bought commodities and gold. He's got some dire warnings about what the markets and the economy, what we're likely to face very soon. And he gives some wonderful investment advice for all of us. So let's just start by cutting to a clip where he talks about his purchasing of commodities and gold, and pay attention to how he describes gold.
Well, currently I'm very challenged. We were lucky enough to have made some money up until now, the last 6 or 8 months, primarily by having let me call it a matrix of short fixed income, short stocks, and not doing a whole lot in currencies, and owning some of the key commodities, particularly oil and mistakenly gold, but copper. Things are a lot harder now because we're now getting definitive signals that the economy may be weakening, particularly at the front end. And while I'm not comfortable owning bonds, I'm much less comfortable being short fixed income to the degree I was 3 to 6 months ago when it looked like a much better risk reward. And even stocks, so many companies have been derated by 60 or 70%. And I've lived through enough bear markets that if you get aggressive in a bear market on the short side, you can get your head ripped off in rallies. So currently I'm coming in every day and I'm looking at my screen, but I'm pretty much taking a break. I'm waiting for a fat pitch. I'm not shooting at any pins, to use a golfing analogy. My anticipation is I will be going back to the short equity position at some point if the market affords me. If not, hopefully I'll just sidestep a decline. That's not the worst thing in the world.
Okay, so he describes his investment in gold as mistakenly. However, he talks about gold and Bitcoin and the different scenarios that you'd want to own gold and you would want to own Bitcoin. So what we'll do is we'll just cut to that short clip where he describes the different scenarios where you'd want to be in one or the other.
I'm not sure why, other than NASDAQ type risk play takers are the ones that tend to play in Bitcoin, and curmudgeons that are gold bugs and want the world to fall apart play in gold. But there's no question, and this I've watched and it's gone on long enough now that I believe it, that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase for other assets, you want to own gold. And I think I just articulated the reason, but sometimes, John, I don't care. This has gone long on enough that I'm starting to believe what I'm observing. And for sure, if I think we're going to have an inflationary bull market, I'd want to own Bitcoin more than gold. And if I thought we're going to have a bear market, stagflation type thing, I'd want to own gold. Doesn't mean I'm going to believe that in a year, but that's my assumption going forward from this point.
So there you go. Now, I think, and I've been arguing for a long time, that I see a 1973-74 style event where we have stagflation, where we have a 50% fall in nominal terms of the stock market, yet CPI remains elevated, 12.5% in 74. And so I see a more of a stagflation environment, and I think we've seen how Bitcoin and crypto has traded in recent times. Pretty much follows the liquidity in the NASDAQ. I think we're heading into a very bad stagflationary environment with interest rates up, oil up, and in fact, that now leads me to the next clip that I want to share with you guys. Stan was sharing his story about his 99 to 2000 during the 2000 .com bubble, where he made some big mistakes, but he came back and smashed it out of the park. So if you want to listen, once again, I'll put a link in the description to the full episode. I highly recommend it. But what he talks about is a scenario that played out back then, where he shorted the market. He just felt so confident about shorting the market, and he did it through buying bonds. Anyway, you'll hear him in a second. But notice how he says the comparison, the setup back then is very similar to today.
But oil is up, interest rates are up, and the dollar is up. By the way, that might sound a little familiar. And this has always been terrible for corporate earnings looking forward. So I mentioned this to my good friend Ed Hyman. I go, what's going on? And I said, oil is up, interest rates are up, and the dollar's up. Why is the market up? In the meantime, I'm calling all my ex-clients who are small businessmen. I didn't have big fancy clients, and they're all telling their business is terrible. Okay, so Ed sends back a regression thing 2 days later showing that if you have oil interest rates, he plugged in the percentages, and the dollar up this amount, earnings the next year forward based on history go down 35%. And the average earnings estimate of the Wall Street guys is up 18. So I then get the idea, and I'm down. And one of my trading rules is you don't trade a lot when you're down. But I've had a break. My mind is fresh. I just love this idea. So I put 350% 10-year equivalent of the fund into treasuries, betting that Greenspan, who has a tightening directive, will reverse and we'll go into a recession. And to make a long story short, I make 40% in the fourth quarter, even though I had given up on the year and decided I was finally going to have a down year. That's the end of the story.
So there he shares the back end of this story, of this trade that he did during the dot-com bust, where oil was up, interest rates were up, and the dollar was up. And he just mentioned that, similar to today. So what we'll do now, we'll just cut to another clip of Stan where and it's two clips, I'll put them together, where he warns about some similarities to why he shorted the housing market in 2005 and what he's seeing today. And then also another guy warning about his basic 40 years of investing, and something he said after the global financial crisis. And we'll just cut to the clip and you'll hear what he's got to say.
I'm glad you asked this, because this is my 45th consecutive year as a chief investment officer. And in 45 years, I've never seen a constellation while I was a practitioner, or frankly studied one, where there's no historical analog. So right now I probably have more humility in terms of my views going forward than I've had maybe ever. But I would say, if I have an objection out there, in 2009, I made a statement inside the firm was, well, we won't have another financial crisis for 30 or 40 years, because once you have one of these, everyone learns from it and we get disciplined, and it takes them that long to screw up again. The last one we had was obviously 29. I'm not so sure I buy into all this stuff about bank balance sheets and this and that. What the central banks globally have done the last 10 or 11 years, I'm not predicting this, John, but it leaves me open-minded to something really bad. So that's the guy on this shoulder we were talking about earlier. The other shoulder is saying, this is an analysis harder than you've ever faced in 45 years. So please be open-minded, because this is not a story we've seen before, so the ending is not as predictable as it has been in other parts of your career. 2005 was a no-brainer, I thought. By the way, I didn't make much money in 2006.
Why was it such a no-brainer?
Because I looked at a housing chart, and for 50 years it went up like this, and then in 5 years it went like that, and I knew that people had taken 800 million home equity loans out and spent it, and I knew that all this stuff was going to come back on the bank balance sheets, because they had securitized this stuff with CLOs and stuff, but they had done it in a way that it could come back. And I had a brilliant analyst from Lehman Brothers come in, sort of your story earlier, probably the best example of it, lay out the whole subprime thing for him, and he said, by the third quarter of 2007, all hell's going to break loose. And by the way, by the time he left that meeting, over the next 2 days, I shorted everything to do with housing. And in 2006, I was wrong for 6 months. It drove me crazy. But the analysis was consistent. So the deeper we dug, the more confident we got.
So, you said after the GFC that we won't have another financial crisis like this for 30 or 40 years. Now, you're not predicting it, but you're just saying you're not so sure. What could that look like? Is this, you tied it to money printing? Is this a dollar losing reserve currency status issue? Is this another banking crisis? What, again, I know you're not saying this will happen, but as you think about the grim scenarios, what could they look like?
I mean, I'm really not predicting this, but think of the 30s, a post-asset bubble, just absolute destruction in buying power going forward. And then do we have the Fed pump it all up again and we get some kind of horrible sort of stagflation thing? Or do we actually get deflation? I hate to be a hedger, but somebody always asks, is this going to end in inflation or deflation? I go, I don't know, 70% inflation. This was a year and a half ago. 30% deflation. They said, what do you mean deflation? I said, well, we've never had inflation because we were too close to the zero bound. That's why I was so angry at the Fed worried about 1.7. Every deflation has has followed an asset bubble. And since the Fed has created the biggest asset bubble, and by the way, there's other central bank rhythm in history and the broadest, even though a lot of the air has been let out of the balloon, it's so big. I just have to be open-minded to the consequences. So we've had two really bad ones in the last 100 years, the US in the 20s and Japan in 89. They're still suffering. So it could be just no growth and sideways for 15 or 20 years, like 66 to 82 in terms of the markets, or it could be something more pernicious like we had in Japan. Frankly, I don't know. I'm just trying to be open-minded.
All right, so definitely some serious warnings there from Stan. Now what we'll do is just cut to a couple of clips where Stan shares some investing lessons and how he invests both in growth and also where he sees opportunities in not just growth, but energy stocks.
I have a bias toward growth stocks. Luckily, not so big of a bias that I didn't ignore it the last year or two. But I think if you can envision a company that 3 to 5 years from now is going to be in a much better situation than it is today, long term, that's my bias where to go. But yes, on a cyclical basis, I've always done what you said, maybe because one of my first groups was chemicals, and they were really easy, John. When they were losing money, you were supposed to buy them because everybody shut capacity down the next 2 or 3 years, but people were still going to need chemicals. And when they made a bunch of money, this was when the markets weren't efficient. They used to announce all these capacity expansions so you knew what was going to happen. Well, I've taken those lessons, forward 30 or 40 years, and they still work. So, yeah, I do a lot of counter-cyclical stuff, but really I'd say the biggest money I've made in equities have been in growth stocks over time.
Yeah. And how about energy? You mentioned the world being short energy. How do you actually put that into, how do you actually trade that?
We're there. I mean, it's been widely publicized, people looking at 13Fs, by the way, which I would caution against because that's old data. And in this case with us, it's true. Very nervous because it's not the unique thesis it was 6 months ago in terms of looking out 18 months where these companies might be. But I think the reasons we're still there is we just see this thing as being more sustainable because of ESG and all the reasons we all know about, that it can last a while, and that doesn't seem to have been priced in the stocks. But it's not a classic Duquesne play because it's now become widely recognized. But I don't just sell something because people talk about pain trade. I don't care about pain trade, this or that. We think these companies are still cheap relative to what we see a year or two out. The big problem would obviously be if you have a horrendous worldwide recession, but we'll look for we're looking for demand destruction in energy, but so far we don't see it.
All right, so for our final clip with billionaire investor Stan Druckenmiller, Stan gives his best advice for a brand new investor, for new people in the investment business. He shares his best piece of advice. So let's cut to that clip now.
I think fundamentals are fundamentals. Look, when companies are losing money, capacity is always going to shrink and their margins are going to look better in 3 years. When companies are over earning, their margins are going to come down in 3 years. I think all that stuff will be out there. I think the great thing about my original mentor, Spiros Drelis in Pittsburgh, was he made me focus on what moves the stock price. Like, you can't just say, Stan, okay, this is a great company and the earnings are great. He said, tell me how people are going to think differently in 18 or 24 months about the situation than they're thinking now. That would be my number one advice to the young people. Do not invest in the present. The present is not what moves stock prices. Change moves them. And I want you to try and envision a different world in a year and a half from now and where these security prices would trade versus now, given the world you envision. That would be my number one advice to a young person getting in the business.
So there you go. Billionaire investor Stan Druckenmiller's number one advice to young people or to new investors, new into the investment business, is don't invest based on where the world is today. Try to envisage where the world is going to be in 18 months, 2 years, 3 years from now. Basically, what I've been saying, or quoting the great man Wayne Gretzky, skate to where the puck is going, not to where it's been. That is basically what Stan is saying. Don't invest based on today. Try to see where things are going to be in the next year, 2 or 3. For me, it's over the business cycle, and that's where you invest. And with the macro outlook that I see and the stagflationary environment, you guys know my views on the whole energy sector and why I think we're going to have high energy prices for the rest of this decade. And I've shown charts before, the correlation between energy and CPI. I do see a 1973-74 style event because of those exact things with higher interest rates. So central banks are going to try to fight inflation, but CPI is going to remain elevated because of energy and food, the things that we need, because of government policy. And what they're going to do is prick the debt bubble. So assets that are being pumped up via debt are going to come down in a big way, just like in 73, 74, yet CPI is going to remain elevated. So we're going to have a poor economy, low GDP, but high CPI. And for me, that's why I like to own gold and silver. And even more so right now, gold and silver stocks, explorers, producers, etc., because they're even more underloved than the underlying metal. Anyway, guys, I hope you enjoyed this video. Hope you got some valuable education from Stan. If you like this video, please hit that like button. Really do appreciate it. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.